Good morning, everyone. My name is Benoist. I'm a technology research specialist working for Natixis in London. And as 2025 draws to a close, what better time to look back at one of the most talked about phenomena of the year, Bitcoin Treasury Companies, inspired by Michael Saylor and his firm's strategy in the United States. These companies seek to exploit inefficiencies, inconsistencies between traditional capital market and the world of digital assets to accumulate Bitcoin on terms favorable to shareholders. In the space of a few months, Michael Saylor, for example, has been able to build the world's largest Bitcoin treasury reserve with over 641,000 units worth more than $60 billion at current market prices, becoming one of the largest corporate issuers of convertible bonds, pref shares, and common equity, prompting many entrepreneurs to try and do the same. Investors initially loved the idea, eagerly snapping up every new project. Bitcoin treasury companies quickly saw their share price soar, often well above the net asset value of the Bitcoins held in portfolio before gradually losing steam and returning to square one. As volatility is biting back and appetite for risky assets is now seemingly on the decline, the big question for the sector is, where do we go from here? To help us see clearly through all that, we welcome Alexandre Laizet, Director in charge of Bitcoin strategy at captivated, the first and largest Bitcoin treasury company in Europe. Together, we will look at what went right, what could have been better, what comes next. But before we do that, please remember that you can ask all your questions on the sidebar of your screens, and we shall take a few minutes to look at them at the end of this session. Alexandre, welcome to the studio. It's a pleasure to have you here today. I think you've been quite busy recently, traveling all over Europe and the world to participate to forums and conferences.
Indeed, thank you so much for the invitation. As you mentioned, I'm Director of Bitcoin Strategy at captivated, Europe's first and largest Bitcoin treasury company. And over this month, while we see a lot of market volatility, we've never seen that much institutional interest and curiosity as the premiums of the Bitcoin treasury companies have been compressed. A lot of institutional investors are starting to look at this in a deeper way and to evaluate the risks and opportunities.
Right. So we're going to go back to all of that, of course, in a moment. But before we do, for those who maybe do not know you yet or have never heard of captivated before, perhaps you could give us a brief overview of the company and give us the reasons behind the shift into Bitcoin treasury relatively recently.
So Bitcoin as an asset class is emerging among institutions as the best store of value, or at least as an alternative store of value in the digital era, and progressively replacing gold as the unquestionable asset with its fixed, unmanipulable fixed supply. And so Bitcoin in this context is gradually and increasingly adopted by financial institutions with the rise and success of the ETFs in the US and with the success as well of Strategy, the first Bitcoin treasury company in the world. And in that context, captivated positions and has positioned as the third Bitcoin treasury company in the world since November 2024 and is providing the most institutional, the most liquid, the most investable way to have a form of exposure to Bitcoin over in Europe for institutional mandates in equity, institutional mandates in debt instruments. And captivated has seen over the period of the launch to now a growth in the share price that's been outperforming Bitcoin. Even year to date, Bitcoin is down 3%, captivated is up 150%. And so there has been a lot of volatility up and down, plus 3,000%, minus 70%. But the net asset value of Bitcoin of the share has only gone up. And we have started the strategy at 10 cents. At the time, the company used to be involved in traditional services in technology. And we've kept the operational activity that was profitable. And we've added a Bitcoin treasury company strategy that has allowed the company to become the largest holder of Bitcoin listed in public markets in Europe. And that has allowed the company to become the most interesting company over in France in the investor forums in Boursorama, for example, and the fourth investor community in the world in Bitcoin treasury companies, and mentioned regularly as well by Michael Saylor and Strategy as one of the most notable Bitcoin treasury company in the world. That's been due to the fact that we've been the third digital equity issuer, so Bitcoin-backed equity issuer since November 2024, and the second digital credit issuer since March of 2025, after Strategy with the preferreds and now Capital B as well with the Bitcoin-denominated convertible notes, and much more to come, obviously.
Right. So let's focus a little bit on what this strategy is. Bitcoin treasury companies are, like I was saying in my introduction, essentially exploiting inefficiencies between traditional capital markets and the world of digital assets. And the idea really is to accumulate Bitcoin faster than you have to sort of dilute your shareholders. And the most probably obvious manifestation of those inefficiencies is the premium that equity investors have to pay above the Bitcoin NAV that is in portfolio. So sometimes we've had companies trading 2, 3, 6 times above the net asset value of their Bitcoin. How do you justify this premium? Where does it come from? How do you explain it, actually?
So the premium of a Bitcoin treasury company is actually the materialization of the valuation of investors of the potential future value added by the Bitcoin treasury company to shareholders. In traditional markets, investors don't only value the factories of Hermes, for example. They value the future earnings. In Bitcoin treasury companies, the earnings are now the additional Bitcoin that is added to the balance sheet without dilution. And the killer use case of digital capital, Bitcoin, is actually digital credit, the issuance of credit in capital markets that allow for Bitcoin treasury companies to add more Bitcoin per share with reduced to minimal issuance of new shares. And that allows the Bitcoin treasury company to effectively securitize Bitcoin. Bitcoin is the raw material that is at the base of the balance sheet, the foundation of the balance sheet. And on top of that, the Bitcoin treasury company taps into credit markets to add more Bitcoin per share over time. And that creates, on the equity side, amplified volatility and potential risk and returns. And on the credit side, it provides with returns and risk-return profiles that are either stripping the volatility away to provide the USD fixed yield and transform that into a BTC yield for the company, or to provide with different instruments such as convertible notes as well that allow for the investors to take advantage of volatility and for the company to take advantage of premiums in the issuance of potential new shares.
So, and that premium is, of course, completely central to the accumulation strategy. The bigger the premium, obviously, the more Bitcoin you can accumulate on favorable terms. So in that context, how do you actually measure the performance of your accumulation strategy? Can you explain a little bit how you look at this, and perhaps how Capital B has performed as well since the beginning?
So for our shareholders, the main indicator of performance is the share price. And so our focus is definitely to do everything at our disposal to maximize the share price performance over time in the objective of outperforming Bitcoin over a sufficiently long time horizon. And so when Bitcoin is a long-term play, a Bitcoin treasury company is definitely also a long-term play. At the same time, traders and volatility professionals will find ways to generate profits as well in the short term. But the management is focused on the long-term maximization of Bitcoin per share and of the amplification of Bitcoin returns over time. And the key metrics that we focus on at each transaction is the BTC yield. The BTC yield is the increase of Bitcoin per fully diluted share over time. And each transaction that we evaluate and that we do is based on one, the maximization of Bitcoin per share at the operation level, and two, the maximization of the possibility of generating future Bitcoin per share. And to put that in a very concrete way, when we have proposals from institutions for capital B to raise more capital, we have to evaluate whether that capital raising operation will not undermine the future capability of capital B to raise more capital. And so each capital raising operation should allow for more capital raising in accretive terms. And so at capital B, we've only taken credit and issued credit instruments denominated in Bitcoin, so we have no fiat leverage. And on top of that, it's only on a 5-year time horizon to date. And so that is the result of a strategy that is long-term oriented, and that is a result of a strategy that is risk minimized to make sure that the company can handle a full bear market in Bitcoin without needing to do a capital market operation. And the third aspect that is extremely important for capital B is also to have an operational reserve that we have aside of the long-term strategic reserve that we publish in our KPIs, to have a short to medium-term operational reserve that allows for the company to cover its normal operational costs to make sure that the company doesn't have to do a capital raising operation, but rather have the capacity to negotiate the best terms for its shareholders.
And so today, Capital B owns
2,818 BTC.
Okay.
From 40 Bitcoin in December 2024, we have grown our Bitcoin on the balance sheet to 2,818 BTC. And our Bitcoin per share growth year to date is 1,656%.
Right.
That can explain in part the outperformance of Bitcoin that we've seen from the beginning of the strategy, which is 3 to 4x outperformance of Bitcoin.
Right. Let's go back a little bit over the financial engineering. You've mentioned a number of instruments. It's actually, the way I look at this NAV premium again, and this strategy is really momentum driven in my opinion. Like companies like yours have to go back regularly to the market to keep accumulating in order for that momentum to be maintained. And so this requires tapping into many different types of investors and being very, very creative and sophisticated in terms of financial engineering. We've seen Michael Saylor go to the market, be one of the largest issuer of converts. People like Mara Holdings as well have issued like more than 3 billion converts over the past few months. There's at the market equity programs, there's pref shares, perpetuals, restriking warrants. Really, it's quite impressive. You mentioned your approach of credit. Is this really, is this your favorite way of approaching the market, or do you see room perhaps for other ways to attract funding for Capital B?
I'm convinced that your worst enemy is to pursue your good idea at the expense of your great idea. The great idea is that Bitcoin is replacing gold as the standard store of value in the world. That is a 10x opportunity as of today at least, from $2 trillion to $20 trillion, which is the market cap of gold today. And that on top of digital capital, Bitcoin, the great idea is to issue credit to accumulate as much Bitcoin as possible in the fastest and most accretive way possible. And so a lot of companies that struggle to issue digital credit or that struggle to see that opportunity or to focus on that opportunity will explore thousands of ways to play with Bitcoin, try to trade Bitcoin, or do different types of operational things that will over time underperform the focus on the best idea, which is to issue digital credit on top of digital capital. And that model is not new. The model of issuing digital credit on top of digital capital, or rather to issue credit on top of capital, has been already done in thousands of years. And more specifically, in hundreds of years, in the 17th and 18th century, when the Bank of England was created. At the beginning, it was a group of entrepreneurs that decided to accumulate gold and to issue equity and credit to accumulate more gold in a private form. And over time, that became the Bank of England. And after that, a gentleman called Napoleon ordered the 100 richest families in France to form a corporation that would accumulate gold and issue credit on top of it. And that became the Banque de France over time. And so we are not banks. This is a Bitcoin Treasury Company. It is not really comparable to a commercial bank. It is an operational company that focuses on the issuance of digital credits to securitize Bitcoin and provide different forms of exposures to the credit markets that represent a $300 trillion opportunity today, which is much bigger than the $2 trillion market of Bitcoin as it is today. And so that's how you've seen Strategy create the market for digital capital and digital equity in public markets with Strategy the equity, and then create a different form of monetary fund equivalent with an effective 10% yield in USD terms that is directly competing with treasuries in the traditional sense. And so the Bitcoin Treasury Company, in a world where Bitcoin is adopted by financial institutions, is emerging as the cornerstone of the emerging digital capital markets, as it will have the Bitcoin Treasury Companies that are able to gain regional dominance. They will have the largest balance sheet in their country, in their continent, and they will be able to establish a form of digital monopoly, as we've seen with the Magnificent Seven in the internet. Strategy will gain a form of monopoly in the US in the issuance of digital securities. And Capital B, the objective, is to focus on that greatest idea and to gain a form of monopoly over in the Europe for the issuance of digital securities as well.
Okay. So, I mean, talking about digital credits, obviously, you will appeal to, let's say, fixed income type of investors. The idea of perhaps looking at other types of instruments is to tap into other categories of investors. I know that, hedge funds have been interested in playing converts because of the possible volatility arbitrage that comes out of it. Retail investors might be interested in simply buying shares. One advantage in the US is that there is this huge market depth and liquidity and very diverse investor profiles all over the market. How does that compare with Europe? Do you think that you've got enough market depth? What are the investors that are actually interested in investing in a company like yours?
So the reality of the market is that it's like Bitcoin in the 2010s. It is extremely early, and institutional investors are just starting to evaluate the situation. And you've seen in the US, as you mentioned, Strategy in 2024 took 7 to 10% of the convertible market in and of itself. So the demand is there, and in the United States, institutional investors are more inclined to take risks in certain periods, while in Europe, institutional investors are a bit more conservative. And so that can take a bit more time. At the same time, Capital B is an international company. 90% of the funds that we have raised is from international investors. But we have very strong local demand from retail, high net worth individuals, family offices, specialized funds. We cover 90 plus countries. 40% of our shareholder base is from the EU outside of France. 40% is in France. And the remaining 20% is from the United States and abroad. And so what you can see is that in Europe, the institutional demand is very low for now. And at the same time, that is where the opportunity lies. Because when you have an adoption cycle of Bitcoin treasury companies in the US and a bit lower in Europe at the beginning, and that you see that the companies can continue to grow, over time the institutional investors will continue to come in if the instruments that are issued make sense for them. Frankly, in the discussions that we have, institutional investors are looking at very objective parameters. What is the market cap? What is the liquidity? What is the volatility? Today, the market cap is very close to the levels where institutional investors of size are going to allocate in capital B. At the same time, there is a bridge to close to make sure that capital B goes from 300 million of market cap to about 501 billion. We already have a lot of interest from institutions at those levels. And the second, the liquidity, well, we have the largest liquidity in Bitcoin treasury companies in Europe. Still, it is lower than the liquidity in the US. But at the same time, it is now noticeable. It is the largest volumes of Euronext Growth Paris, and it is the most active stock from retail investors. So there is a lot of activity that is interesting, and over time this will go to the thresholds where institutions have the mandate to act. And then, in terms of the instruments that we can issue, the most attractive part of a Bitcoin treasury company is the volatility. And the volatility of capital B is about 150%. So when you have the ability to lock in a 30 to 40% volatility materialization in the form of a premium, but that you can access a potential 150% volatility, that is quite an opportunity. And so we are definitely convinced that capital B is on the right path by making sure that we provide the right level of transparency to investors on our website and on our communications for the time where they are ready to act. And we have already started. We have done the first ABB program back in September with 40 institutional investors, and that has been the first in Europe, and we are the Bitcoin treasury company in Europe with the most institutional investors. So institutions are here, but it's just starting, and it's really like the 2010s for Bitcoin. Everyone knows it will happen. At the same time, everyone is questioning whether it is now or later. And now when we look back in the 2010s and we look at people that were able to buy Bitcoin in cents, we call them lucky. But in fact, they had a vision, a conviction, and they effectively executed it.
So it's interesting that you mention volatility as an advantage, because 150 volatility for me, and maybe I spent too much time in equity derivatives in the previous career, but 150 volatility is synonymous with a lot of risk for me. And last month, S&P actually gave strategies, by far the biggest Bitcoin treasury company, a credit rating of B-. A lot of people thought, that's great. The company is being recognized by traditional finance, but B- is actually a junk rating. And it looks like S&P were not particularly confident in the ability of the company to actually honor their financial obligation in certain, market stress scenario. Do you think they're misunderstanding something? They're missing something? How do you think about this rating?
So it's S&P themselves that state that they are missing something. They literally state in their report that they do not take into account Bitcoin in the balance sheet of strategy, which is frankly a bit ridiculous. At the same time, it is conform to the rules that they have of not treating a new asset as what is today the US dollar. And so if you do the rating of a Bitcoin treasury company without taking into account the Bitcoin on the balance sheet, it is quite surprising. It is a very good news for the industry overall, because S&P has taken the step of evaluating a Bitcoin treasury company, the largest one in the world. And by doing so, a lot of institutional investors that require as a checkbox to have a rating now have it. And the institutional investors, they will do their own calculations and they will not rely on the rating of S&P because it does not take into account Bitcoin. So if you don't take into account $60 billion value of Bitcoin in the balance sheet of strategy, well, that is not very much reliable. You could apply a conservative rating. You could say that, yes, Bitcoin could go down by 30, 50%. That would be potentially more adequate. But at the same time, S&P was also careful and cautious of not attributing a rating that would be outside of the returns of the products that strategy issues at 10%.
Yeah.
And so S&P will gradually follow the steps of the market and the understanding of the market. Strategy will also be including over time in the S&P 500, and over time it will just be including much more into the traditional evaluation frameworks. And so I really congratulate S&P for making that first step of adding a rating for the Bitcoin treasury company. The next evident step will be to treat Bitcoin as an asset in the balance sheet and to apply conservative criteria, but that will come. And so as an investor, you have the choice of waiting for S&P to adapt or of already treating Bitcoin in the balance sheet as a valuable asset. It's like if a real estate promoter, you would not take into account the real estate on the balance sheet. It doesn't make sense.
Right.
But S&P states that in the report as a limitation already.
Yeah, and they seem specifically worried of what would be happening if strategy had to sell large chunks of their Bitcoin treasury holdings to honor financial obligations, and what could be the potential consequences for the entire Bitcoin ecosystem. Do you think there's, when these companies are accumulating so much Bitcoin, do you think there's systemic risk for the digital asset ecosystem somehow?
So the systematic risk for a Bitcoin treasury company are more systemic risk coming from Bitcoin itself or Bitcoin custodians. But from the pure Bitcoin treasury company strategy model set up by strategy, the risk of selling Bitcoin is extremely low. Bitcoin could go by minus 80 to 90%, and strategy would still be able to honor its obligations potentially with the preferreds. So the risk effectively for every Bitcoin treasury company investors is that Bitcoin would fall sharply and for a prolonged period of time of 4 to 5 years. And that has not happened in the past. It's not necessarily a good indicator of the future, but the largest risk for this happening is that central bank would coordinate globally to stop printing fiat currency, which is not happening anytime soon. So just by taking into account the fiat debasement that we see over time, about 10 to 15%, which is literally the performance of the S&P 500, which is about like a stable coin, taking into account the inflation of money supply, then you can see that Bitcoin is not necessarily going down. Rather, it's fiat currency that is going down and Bitcoin that is adjusting over time. So in that respect, the obligations of strategy are very likely to be met, and even S&P states that, but because they don't take into account the Bitcoin on the balance sheet, then they state, of course, that there is a risk. But if you take into account the Bitcoin on the balance sheet, effectively strategy is under-levered. It's levered at like 10 to 20% maximum today. And so in that respect, Bitcoin can go down very significantly. Strategy today, with 1% or 2% of the proceeds of their ATM facilities, they can cover their obligations under the preferred stocks. Yeah. So the risk is extremely low. And then there is, of course, there are a lot of risks that are described in the financial statements of Bitcoin Treasury Companies. The custody of Bitcoin from the banks. Bitcoin could have, of course, any type of risk. It's not the case today, but of course, every investor needs to continue monitoring whether Bitcoin remains sufficiently decentralized and secure. Because if Bitcoin is sufficiently decentralized and secure, then it has a fixed supply, and then the fiat currency devaluation is happening, and investors are going to the scarcest asset on earth, which is Bitcoin.
So one potential risk as well that I see with holding Bitcoin is that it's very difficult to extract yield from Bitcoin. So you have all these holdings, but you can't do much with them. Of course, you could potentially lend the Bitcoin, get some borrow fee on top of that. You could perhaps issue an ETF yourself and compete with BlackRock. Perhaps you could do a certain number of things on the DeFi world and lend, but then you take probably some smart contract risk and new type of risk. What one thing that I look at as an analyst is that the core activities of a company like yours or the legacy business are typically generating not enough cash to honor the financial obligations of the company. Have you thought about ways to actually monetize your Bitcoins differently and to extract extra yield so that you could pay more coupons or more issue more debt product like that?
So doing things with Bitcoin on the asset side limits the ability to do things with Bitcoin on the liability side. So the true and most important and the most the one that has the most potential use case for Bitcoin on the asset side is to issue liabilities on top of it in different durations in a way that maximizing Bitcoin per share. That is the role of a pure Bitcoin Treasury Company model, like Strategy, like Capital B. Other companies are starting to develop as well operational activities around Bitcoin. That is a potential for a Bitcoin Treasury Company, and in fact that is one of the major strengths of a Bitcoin Treasury Company, is that you have this nuclear weapon on your balance sheet that in time you could definitely use to generate more Bitcoin as you go. At the same time today, the counterparts that exist in the Bitcoin ecosystem to generate yield in the traditional sense on Bitcoin typically will take unreasonable risk, or they will play with Bitcoin, or they will sell Bitcoin to generate that yield. And so if you do that with 5% of your Bitcoin and then you generate 5% yield, that is extremely minimal and not worth the risk. It is much more beneficial for a Bitcoin Treasury Company to leverage as a collateral Bitcoin in the issuance of credit that can maximize Bitcoin per share. So that is the vision of Strategy. That is the vision of Capital B. At the same time, you don't know what will be the world in 5 years and what traditional financial institutions will provide as a service, and whether or not you will see the emergence of new parties that can provide reasonable services to Bitcoin treasury companies. But the business model focus of a Bitcoin treasury company is not this. For this, you can go to an asset manager, you can go to a professional Bitcoin yield generating activity, but a Bitcoin treasury company provides much more yield than that. You know, with generating 1,600% BTC yield in the sense of Bitcoin per share increase, and that over time it's much more potential returns than a 5% yield on 5% of the Bitcoin.
But you still have to to basically generate, or many companies have to generate fiat coupons, right, for their investors. Have you looked, for example, at selling options on your Bitcoins? I think given current prices and volatility on Bitcoin, you can do much more than 5% annualized, probably around like 15, 18% selling, 3 months, 115 calls on IBIT, for example. Or you could even potentially sell puts, and market goes down and you end up buying more assets at the price that works for you. Is that not something that you think is actually quite tempting?
It's definitely possible. In fact, it's one of the strategies today of Metaplanet. It's the leading company in Bitcoin treasury company in Asia, and has been having a Bitcoin income generation strategy with 5 to 10% of their capital raises that they allocate to a strategy that would use options on top of Bitcoin. And so that is a model that is emerging, that we look at. We keep options open. And that is the strength of a Bitcoin treasury company, is to have these options. At the same time, today, we don't need it. Because when we do capital raising activities, we will keep a very small portion, maybe 1% or equivalent, to make sure that we have an operational reserve that allows for the covering of the minimal Bitcoin treasury company costs of the company. On the other side, we have an operational business that generates about 10 million of revenue and about 1 million of EBITDA. And that is also in and of itself self-sustaining. And the Bitcoin treasury company as well is self-sustaining by the capital raising operations that we do. Our business model is to securitize Bitcoin. And when we securitize Bitcoin, we have about 90 to 95% allocation to Bitcoin directly, about 3 to 5% of allocation to the cost of legal structuring, of banking intermediation, and so on. And we have a very small portion for the very thin team that is dedicated to the Bitcoin treasury company. And today, aside from our 2,818 BTC strategic reserve, we have an operational reserve of 4.5 million euros and 59 BTC. So that's about 9 to 10 million euros compared with our Bitcoin treasury company costs of a year that could be around 2 to 3 million. Okay. So you can see that the importance for Capital B is to be able to sustain a traditional bear market and to select the capital raising operations that we do.
There's also a number of question marks from potential investors on governance of Bitcoin treasury companies. And to be fair, not every Bitcoin treasury company is always very transparent about that. And one thing that people want to know is, how you hold your Bitcoins, where do you hold them? And is it possible, for example, for Alexandre Laizet to basically just disappear with those Bitcoin in some kind of remote island? Or is it something that is much more, shared as a decision? And how does that work at Capital B?
So, in fact, that's been very important to us since the beginning. You know that a lot of Bitcoin treasury companies actually hold, for easiness purposes, Bitcoin on exchanges, in crypto exchanges. Capital B, since the beginning, has held its Bitcoin on regulated banks. And regulated banks doing cold storage with the use of technology provider Taurus in Switzerland, which is the gold standard, if not the Bitcoin standard, of technology, custody technology. And one very important thing to know is, as Michael Saylor says, nobody wants the CEO or any member of a Bitcoin treasury company to walk around with the keys of the Bitcoin. We do not hold the keys. This is delegated to a regulated bank with the participation of our lawyers, with the participations of our auditors. And in that respect, the strategy of Capital B is extremely protective because all of our counterparts in France, Banque de Lubac, in Luxembourg, and with Switzerland as well, with Swissquote, the regulated banks, everyone knows with our lawyers, auditors, that the strategy is to not sell Bitcoin and to not lose Bitcoin and to not send Bitcoin to an unknown place. And so in that respect, any request that would go against that principle is deemed as fraudulent. And so that means that no single person at Capital B is able to move Bitcoin around without having a bank involved, without having lawyers involved, auditors involved, and that provides with the highest level of security that you can have, and that provides as well with individual security because nobody wants to be able to move those assets alone.
Let's talk about what comes next. Obviously, if you look at the share price of Bitcoin treasury companies in the past few weeks, it's been quite, bearish. Those companies have experienced a big boom at the beginning of the year, and now basically you can see it's going back to square one. So, a lot of the reasons behind that is that, we've seen a lot of short selling in treasury companies. Hedge funds have been very active doing that. How do you break that negative momentum now, and how do you get back on, a more positive trend for your company?
So the steps for Capital B is that today we are at about 3,000 Bitcoin. We have a lot of opportunities, 3 to 5 major opportunities for Capital B to go from 3,000 Bitcoin to 5,000 Bitcoin, mainly with BTC-based and BTC maximalist investors that are interested either in the Bitcoin convertible notes that we can issue and that are interested in potential consolidation events in the continent, and that are interested as well in new potential instruments that we could issue. The second step, after we reach those 5,000 to 7,000 Bitcoin on the balance sheet and a market cap that could approach about 1 billion, is the capacity for institutional raises with major brokers and investment banks and institutional investors, mostly in credit markets. And that could allow for the company to go towards 1 to 2 to 3 billion of Bitcoin on the balance sheet, together with the capacity to issue public offerings that could allow both institutions and retail investors to participate in the Bitcoin accumulation of Capital B. And that could be in the form of the preferred type instruments of strategy, but in a way that would be adapted to the French regulation, the European regulation, for Capital B to provide an instrument that would work not only in the bull market, but as well in bear markets.
There are dozens of companies, treasury companies in the sector. There is a new one coming almost every other week at the moment, even after premiums have been compressed. Do you think there is time now for consolidation in the market? We've seen that, for example, with Stripe Sandler recently. Do you think that's the beginning of a bigger trend? Are you yourself potentially looking to acquire competitors?
So the M&A opportunity is not a strategy in and of itself. It can be a distraction for management, but there is really one exception. The exception is one, if that is the potential for a much larger size, or an event that would allow for the company to grow to the levels where more capital could be raised and generate more BTC yield, but only if that provides with a very simple, straightforward execution, meaning that it's not a whole conglomerate that you will merge with, but that there is an opportunity to do something simple. And two, that there is management alignment, because you don't want to spend 1 year of negotiations and end up with nothing. So on top of that, you also need, of course, shareholder alignment. And Capital B is definitely looking at those types of opportunities without having that as a core strategy, but keeping options open. And we definitely have one opportunity that we think could be interesting. But there are trade-offs as well. If you undergo such operations, it means that in certain moments, the company may not be able to raise capital as before, but it could be worth it to wait, say, for 2 months or so, to be able to reach a higher size and issue even better credit instruments in the market and consolidate the leadership of Capital B over in the EU.
Do you think there's value in diversifying away from Bitcoin? What do you think, for example, of these guys who are looking into accumulating Ethereum or other cryptos? Is this something that could potentially become a strategy as well for you, or a side strategy for you?
Never. Everything goes to zero against Bitcoin. Bitcoin is repricing the world. It's the only asset that has absolute scarcity with global adoption. Everything else falls and fails at meeting one or two of those two criteria. And Ethereum specifically fails at the absolute scarcity. Its supply can be manipulated, it can be changed, and that is not acceptable for anyone willing to store value in something. And on top of that, Bitcoin has the biggest, more widened global adoption as well. And so Bitcoin is by far the best store of value in the world. It is the cryptographic network that has 99% of the energy that is providing the security for the network. It's the equivalent of 21 nuclear reactors over the world that ensure that Bitcoin remains secure and decentralized, together with the global adoption as well. So any other crypto asset has literally no reason to exist, except for sometimes creating some innovations in the technology sense that can be used in a business applications for tokenization of financial assets, for example, but you don't even need the token. A lot of banks are taking the technology and using it by themselves, but that doesn't mean that the token has a use case for store of value. It would be like saying that a ticket of transport would be useful as a store of value. No, the store of value in the traditional world is gold. And the store of value in the traditional world is very scarce assets, like scarce real estate, scarce shares of companies that have a digital monopoly. Well, Bitcoin is outperforming all of those asset classes. Real estate is 6% CAGR, S&P is 15%, Magnificent 7 is 30%, Bitcoin has been 60%. So it's more volatility, but over time it's outperforming all traditional asset management strategies and all crypto assets other than Bitcoin. So in reality, Bitcoin is the crypto assets. Everything else is something else that has another use, but that is not a store of value.
So what is the end game for your company? You mentioned, you were talking earlier about central banks and accumulating gold. Are you trying to become some kind of central bank for Bitcoin? And how do you decide to stop at a certain level of accumulation? Why not accumulate more?
The objective is to keep accumulating every day and never stop, and become over time the equivalent of the central bank for digital capital markets. So it is not a central bank in the traditional understanding, but it is effectively to become the main provider of credit instruments to the emerging industry of digital assets. And that will be a major industry of multi-tens of trillions of dollars in 5 to 10 years. And Bitcoin treasury companies that are able to have the biggest balance sheet will have the most opportunities in that regard. And if we accomplish our plan to reach 1% of the Bitcoin supply accumulated on our balance sheet over the next 8 years, and if Bitcoin reaches $1 to $2 million, which would be the equivalent of the current market cap of gold, Capital B could become a $200 to $400 billion company over 8 years, and that would be potentially even part of or even the largest publicly traded corporation in Europe. There is a very long way to go, but that is the objective. It's a big picture opportunity to take custody of the most valuable and scarcest asset on earth, which is Bitcoin, and to issue the best quality credit instruments without burning steps, without taking unnecessary risks, and by focusing on the greatest opportunity.
Is there not something fundamentally anti-Bitcoin in accumulating Bitcoin? It was supposed to be a decentralized asset, and now big whales are accumulating it to infinity. Do you not see like somehow a paradoxical situation here?
It is counterintuitive, but a Bitcoin treasury company is decentralizing Bitcoin. When we started, even back in November 2024, only really 3 to 5 banks in the world were starting to custody Bitcoin. Today, it's tens of banks, including systemic banks, that are starting to custody Bitcoin for retail and corporate clients and institutional clients. And that is much more decentralized than 3 or 5. If you have 20, 30, hundreds of banks all over the world that start to provide Bitcoin custody services and start to compete on self-custody solutions as well for withdrawing the Bitcoin for retail investors and for potentially over time institutions and corporates as well, you have a much more decentralized ecosystem with much more custody solutions available all around the world. And you have also the financial institutions now starting to adopt Bitcoin and provide more payment solutions using Bitcoin rails in the layer 1, in the layer 2 of Lightning and Liquid for the tokenization of capital markets. And that allows for a more broader distribution of Bitcoin overall. And as well, when we work with a lot of brokers and investment banks, that is today hundreds of people that are being introduced to Bitcoin. And over time, all of these new people that come into Bitcoin first as a curious investor and then as an engaged investor and then as a Bitcoin maximalist effectively, are providing more distribution of Bitcoin around the population and providing with more options to custody, invest in, or even outperform Bitcoin.
So do you envisage, if we look at this whole thing from a more global and wider angle, do you envisage like Bitcoin becoming a widespread and mainstream treasury asset for all sorts of corporates in the world? Do you think every company in the world should own some at the moment?
Yes. Bitcoin is money, everything else is credit. And typically we've been confused by thinking that money is currency. Currency is not money. Currency is the medium of exchange. You can use a euro or a dollar to pay for things, to pay for coffee, but if you don't have the store value protected in money, you end up with a currency that is worth less and that even loses its properties even as the currency itself. So money is really two things, is the store value component and the currency component, and of course the adoption and acceptability that is a result of those two properties. The success of the dollar has been, of course, the power of the United States and the capacity of the dollar to have less inflation than all other currencies over time because of that strength of the United States. The issue is that 50% of the monetary supply and more has been issued since COVID. And that is not what we can call a store of value. And in that context, fiat and even the fiat institutions are now inviting companies in the US to adopt more Bitcoin because the US government has realized that the only solution to fiat debt and the monetary issue that we have is actually to pay back the interest of the debt with more monetary debasement. And in that context, you have Larry Fink, the CEO of BlackRock, saying that Bitcoin is the solution. And in that context, you have the capacity to take advantage of that situation and use Bitcoin as this long-term store of value.
Thank you very much. We have 2 or 3 minutes left. Maybe 1 or 2 questions from the audience. Remember that you can ask questions on the side of your screens if you would like to ask Alexandre anything. There's one here about your accumulation strategy. If the accumulation strategy is purely momentum driven, is there not a risk that Bitcoin treasury companies constantly buy Bitcoin when it's expensive and do nothing when it's cheap?
So it is indeed much easier to raise capital where the capital is in a risk-taking mode. At the same time, you can see that the greatest opportunities for investors have been exactly when the conditions were tougher. Strategy between 2022 and 2023 was trading around NAV and sometimes below NAV. And that was immediately preceding the phase where strategy went beyond the roof in 2024 by using and starting to use offensively digital credit. So yes, it is structural. You have phases where it is easier for a Bitcoin treasury company to provide more amplification for shareholders. At the same time, it is also those periods that allow for the company to build the structure that allows for more amplification when Bitcoin is in a more higher and bullish setup. At the same time, we are very conscious of the need to accumulate more Bitcoin in a downside market. And you can see the initial success of Stretch from Strategy and Stream from Strategy, the products over in the US and now Europe that allow for investors to have a fixed USD yield in a scenario where Bitcoin is going down and to continue to accumulate Bitcoin without or with very limited dilution in a downward market scenario. And that ability requires size for a Bitcoin treasury company. And that is exactly what you are noticing today, is that not a lot of companies will be able to effectively tap into credit markets efficiently to generate Bitcoin per share increase, even in tougher market environment. And so our focus at Capital B is really to build that size from Bitcoin native investors to be able to, and of course we are in preparation of, tapping into the capital markets in the credit fixed USD type of yield that can be provided by a sizable liquid Bitcoin treasury company.
One last question. I find this one is interesting. So for hedge funds to short sell your stock, they need to be able to borrow your stock. If your shareholders truly believe in the long-term story, where do hedge funds source the borrow?
Well, a lot of the shares that are available to borrow are in a default mode in traditional brokerage accounts. So unless investors deactivate the capacity for the shares to be borrowed, then the shares can be borrowed. And so a lot of shareholders actually have deactivated that function, which is why we have seen such expensive interest rates on the borrowability of the shares, sometimes 100% or 200%. And so there is a competing two sides of the argument there. The one side is, yes, of course, it is impacting the stock in the short term when there is a lot of short activity. At the same time, more short activity and even the existence of short and options market around the stock is a very healthy thing to have for a Bitcoin treasury company, because for a lot of institutional investors that is a precondition to have and to start a position in a Bitcoin treasury company by having the capacity as well to hedge if that is in their mandate. And so you see Strategy has been the first largest, most successful Bitcoin treasury company in the last 5 years. And they have the most liquid, largest options market and short interest around it. So Capital B, yes, has had a lot of short selling pressure. At the same time, despite this, the company has done relatively well compared with its benchmark. And over time, the short interest and the options market that develop around the stock in IBKR, for example, is very positive for the company as it allows more institutions to come in.
Well, Alexandre, thank you very much for your insights. It was really, truly fascinating. The Bitcoin treasury company is definitely not over, and we'll certainly keep it on the radar in 2026. For now, goodbye from us, and see you next time in the studio.